Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey audience and listeners, this is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing podcast. Today I have Jeremy Cyrier from Boston. Jeremy is one of my mentors. I'm happy to have him here to talk about commercial real estate. And Jeremy has been focusing on Texas and a lot of markets out of North East U.S. like Rhode Island and Massachusetts and of course Texas. And he have done a lot of deals. I think he used to syndicate and now he's also investing as a passive investor. And he focuses a lot on multifamily, medical office business, medical office buildings, retail, and also office. Hey, Jeremy, welcome to the show.
Hey, thanks, James.
What's happening? With all this COVID-19, I know you're not in New York, but you're in Boston, which is, almost near to epicenter there. What's happening with you personally and the commercial real estate business right now?
Well, it's a great question. We're all healthy. We're home. I've got 4 kids, 8 and under, and it's a little crazy, but we're feeling just frankly blessed at this time to have a moment of pause in our lives to focus on the basics together. And I think, amidst all the tragedy that's unfolding around us, that's actually a blessing.
Yeah, sometimes, you have to look for positive things in, whatever situation that we are in right now, right? So tell me, about what are you seeing right now in the commercial real estate space? What was happening in February before this whole COVID-19? And now we are in the middle of it. This is like almost all in April, mid-April to, towards the end of April. What are you seeing right now that has completely caught your attention and create that aha moment for you?
Well, I'll tell you, the interesting thing is we've been over the last 3 or so years saying, well, when's the recession coming?
Yeah, absolutely.
And we were looking for it. We're looking for leading indicators of a recession. And here it is. It's upon us. And it's more of a black swan event than really any of us would have expected to have happened, to such a point where I've been talking to people about this being similar to our country being invaded and the government shutting down our economy as a defense mechanism. So that's a pretty fascinating set of circumstances for us to be operating within right now in any business, let alone the commercial real estate space.
So do you see a lot of transaction has died down right now from what you were doing 2 months ago?
Yeah, so one of the things I do is I track data. So I live outside of the Boston market. I track that data very, very closely to see what the volumes look like. And I'll tell you, the 2020 Q1 data was up 75% in terms of sales volume over Q1 of 19. And so it was a very healthy start to the year. But as soon as you go and you shut down the economy, all the volatility comes into the market and buyers start to pull back. Lenders start to try to figure out what to do, who to lend to, how to lend. And then you've got sellers pulling back saying, am I exposed here? Is this a dangerous time for me to be selling my property? So the first month of this event was really characterized by people trying to figure out what's going on, what's happening. And this last month is being characterized with more intentionality. Okay, here's what I'd like to see happen in 3 months, 6 months, 9 months, 12 months. So the discussions are moving forward to I'm going to stop focusing on the hourly news cycle, and I can see more of a 2 to 3 day news cycle. And within that, environment, I can start to think strategically about what's next for me.
Got it. So do you see, so you're saying sellers are starting to look at more strategically. So I know some people were talking about V shape versus U shape, and I think some of the V would have changed to U right now, right? I don't know whether, or Nike switch, right? So where do you think we are heading from March 2020, now it's
Yeah,
April,
which letter of the alphabet are we going to see?
Yeah.
I listened to a great webinar, which is done with Casey Conway and Eddie Blanton, Eddie's the president of the CCM Institute. Casey's the chief economist. They got on a webinar, and I think you can see this. You can catch it on YouTube. And Casey got on, and he talked about the letters, and he goes through the different shapes.
Oh, okay.
Some of them I'd never heard of before, but they like what happens when you have a fiat currency recession. It's a Q, I guess. But he said, if early on we were hoping for a V, he thinks it's going to be a W. And I think he's right. I think the W is we go through an initial dip. We have a recession now. We start to rebound and recover in the summer as people start to get outside and start to circulate and return the flow of capital. But we go back into a secondary recession in the fall, driven by two primary things. One, concern over COVID, spiking again, and the second being all the bad news that accumulated from March through September. That shows up, and we see a secondary recession as a result of what's happening right now. He said it's probably, and I think he's right, we probably don't start to see the volatility come out of the market until this time next year, 2021. And it's just going to be a matter of riding this, riding things out the best we can in 2020.
So when you talk about the second deep, right? I mean, I think first is the V, and after that there's another V, which is coming in, which makes it a W, right? So are you saying this, from your perspective, do you think the second lowest point will be lower than the first low point, or will be higher than the first low point?
I don't know, but I know those low points take a lot of pain and they dish it out. And so in our business, in commercial real estate investing, people have been asking me, okay, so when are the deals going to show up? Where are all these distressed sellers? Well, it takes time. It takes time, right?
What kind of time? Why do you think it takes time?
Well, if you look back historically, when we've gone through recessions, and they happen just about every 10 years. In the last 40 years, this was a longer cycle than we'd seen. So typically you see expansion kick off in the third year of a decade. You see a transition year in the eighth year of the decade. We go into a recession, then we come back up and out. This one didn't happen that way. And I think it's because the Obama administration didn't push the FDIC to recycle assets like we'd seen in prior recessions, which extended the recovery period. It took longer to recover and expand in this last cycle. So as a result of that, the cycle lasted longer. I think it just was a longer period of protracted growth. So we have, in the time frame of how things tend to play out, on the inside, you might see real estate deals 2 quarters after a Dow correction. But typically I see like a 4 to 6 quarter lag off the Dow. And there's a reason for that. If you follow the money. So start with the Dow. What is the Dow? The Dow is a highly liquid market. People are trading on nanoseconds, and they're trading based on projections and perceptions. So from there, companies their shares are devalued. They report revenue, they have revenues coming in lower, their earnings are lower. They start adjusting their P&Ls, they lay off people. Okay. So unemployment comes up. Then they start to look at their real estate and they say, well, we need to reduce our exposure to real estate. We're not demanding as much square footage. Let's give some back. That goes back to the landlords. The landlords get the space back. They rent it for less, or they can't rent it. They burn through cash. Then they go to the bank and they say, hey, bank, I'm having some issues. Bank says, okay, well, let's work with you for a little while and see if you can get through it. That takes another 3 or 6 months before it ultimately hits the point where the bank says, you have to get out of the asset. We've got to take it. So it's a slower moving, it's a slower moving asset class. That's one of the reasons why people like it. I mean, when you're buying, you want it to happen now. You want it to be fast. But when you own this, it has less volatility than the stock market does, and that's one of the reasons why people get excited about building durable wealth in the space.
Very interesting. So I just want to touch back on what you mentioned just now. So you said during the Obama administration, the 2008 crisis, you said FDIC did not recycle assets as quickly as So can you clarify that? Because that's completely new. I never heard about that.
Well, if you were to go back, so if you look back at the savings and loan crisis, this was back in the late 80s, the Tax Reform Act. What happened was depreciation schedules were changed on how real estate was owned and written off. The tax world had distorted real estate valuations. That combined with the junk bond industry and banks investing in junk bonds, chasing yield, to make money. So those two things together broke down the system. And what happened was the FDIC went into banks and said, we've got your balance sheets are a mess. Your ratios are out of alignment. We want you to call your notes and recapitalize. So banks actually started calling owners up and saying, you have to pay us in 30, 60, 90 days, pay off your mortgage. Well, okay, but when all the banks are doing the same thing, there's a problem. So owners were foreclosed on, they dropped their prices to liquidate their buildings, they filed bankruptcy, and all this real estate ended up coming onto the bank balance sheets, and the FDIC came in and said, okay, well, now we're going to set up a corporation called the Resolution Trust Corporation to liquidate all this stuff, flush it out, establish the market bottom, and then we'll come out of it. So in 2008, a lot of people were thinking that was what we were going to see. We had a finance and demand induced recession. And so we expected to see real estate defaults go back to the banks. The banks would take the properties over. The FDIC would come in and say, push the stuff back out on the street, mark it down, recapitalize, and then we'll get back to business. They didn't do that. Instead, what they did was they came in, they closed the really, really, really sick banks, and a lot of them were set up as M&A deals. So they had other banks buy out the sick banks to dilute the balance sheets and then clear off the sick real estate. But what they ended up doing was they did a lot of forbearance agreements, and they extended loan terms so that they could keep the owners operating the assets even through all the pain of the recession. So as a result of that, we never saw a real markdown or mark to market on all those properties. They weren't quote unquote recycled. So if the idea was to keep all the real estate in all the owners' hands, you saw fewer deals on the buy side, and you just saw these owners just barely making it, holding on to these things, waiting for the economy to start to pick back up and for demand to come back into the space so they could recover the valuations and ultimately refinance the bank off the asset or sell the asset and recover or just break even on it. That takes a little while to do that. Yeah. So I think that's one of the reasons why we saw this sort of longer cycle this time. I mean, a lot of people were looking at Trump's administration and his policies for continuation of this. I do think that was part of it, but I think what we really had was we had a long recovery. And it took us until 2013 to really jump into an expansion phase from 2008. But it wasn't like a jump. It was kind of a slog to get there.
Yeah, you can see 2013 onwards, the cap rates start compressing, a lot more compared to, from 2008 to 2012, right? So
yes.
So do you think that's going to happen in this market cycle where somewhere there's going to be FDIC going to come and do this?
I kind of think that's not going to happen, because if you follow the logic here with me. Mm-hmm. So country gets invaded, government shuts down the economy, people are forced out of business, landlords default on mortgages, banks have to foreclose on property, FDIC makes them and says, now you got to recycle the buildings. So if I'm the owner of the building that went through that whole horrendous experience, I'm looking at the government going, well, wait a second, you shut down the economy and now you're telling the bank to take my building away. Mm-hmm. How can you do that? So I'm not sure that that's the outlet on this one. I think the outlet's probably going to be it's going to be just the market, and it's going to be buyer demand and what buyers are willing to pay. But it's going to be driven by two things over the next couple of years. One is who your tenant is, their stability and their durability to pay rent, and number two, the lending resources that you have available. My concern about this situation we're in is what is banks freezing lending to attempt to reduce their exposure to degradation of net operating income. That's a concern because they take the debt liquidity out of the market. When that happens, that slows transaction velocity down considerably, and that will bring pricing down. And that's, if you're buying, that's the time to buy when money's hard to get. And when it's easy to buy and money's hard to get.
But you still you have a challenge in terms of lending, right? Because the terms may not be as favorable during the peak of the market.
But it's interesting. I think the lenders, when we go through recessions, they get picky by who they lend to. Having relationships with your lenders is critical. So your local banks are extremely valuable. They want to know that they've got strong hands operating these assets and using the money correctly. So those are elements to be very focused on in maintaining those relationships. It's the national banks that concern me with, I was working on a deal last week, and Wells Fargo said, well, we're not doing the deal. We're not lending, period. Just shut it off.
Yeah, except for multifamily, right? I would presume all other asset classes like very, very less in terms of lending. Multifamily, I know Fannie and Freddie is still doing it, even though they have additional reserve requirement, which is good for multifamily. But I think it's just hard to do any deals anyway right now because no one knows what's the price.
What's the price?
No one knows what's the cap rate. I definitely know cap rate has expanded, right? Definitely not compressed or stay from 2 months ago, but how much it has expanded, right? And who's going to take the risk of what are they buying, right? No one knows.
You get back to good old-fashioned cash flow. Mm-hmm. And I always tell people there's always a market for cash flow. In any market cycle, there's a market for cash flow. The key is figuring out who the tenants are. And in multifamily, where do they work? It amazes me when I talk to multifamily investors about their properties. I ask them, when your tenants fill out credit apps, or a rental application, you get their place of business, wherever they work, you should be cataloging every single employment center in your portfolio and finding out which industry sector they're in. Because you could, for all you know, you might have 60% of your tenants working in the cruise industry. You just don't know, So having an idea of what your economic footprint is by income diversity in your multifamily properties is really valuable information to have.
Yeah. Even multifamily near to airports, right, where there's a lot of workers from airports and the airports are shut down, right? So that can be a big issue as well in terms of demographic, right? So we never really looked at it because, but I recently looked at it. It looks like we have a really good diversified in my portfolio. But I don't think so many multifamily buyers have done, demographic analysis until now, recently, right?
Yeah, it's good to do.
Now it's like, okay, you better know who are your tenants, right?
Yeah, you want to know who's paying rent. So I have a question for you.
Sure. Good.
So multifamily deal making, where the deals are, where they're going to be. One of the things that Casey Conway mentioned on his webinar that fascinated me was he said he expects to see hotels converted into multifamily housing. And he also said we may even see cruise ships become multifamily housing.
I just heard recently, in fact, this morning I was listening to a podcast by Robert Kiyosaki and Ken McElroy, who were talking about 10 years ago, someone was pitching this idea, let's convert the cruise ship into a moving condos and sell the condos as an apartment, right? Have you heard about that? That was like, wow, really? Trying to do that? Maybe that's coming back, I guess, right? So,
it may. These cruise lines, they're going to have surplus cruise ships, aren't they?
Mm-hmm, mm-hmm. Yeah, absolutely.
You got to imagine demand will drop off for a considerable period of time in hotels.
Yeah. So let's go back to the tenant demographic analysis and the economy, right? So So looking at what happened in 2008, we did some kind of benchmark with what happened then and what happened now. But what happened now is basically the service industry and the people who are on a paycheck to paycheck, right? People are living paycheck to paycheck. They are the biggest impacted because everything stopped, right? So the people who have higher pay, who are basically living in A class or, who are working in a normal, highly paid job, they are working from home. They didn't lose the job, right? So this is my thinking, right? My thinking is just like, people, once everything opens back up, the paycheck to paycheck is going to go back to work, right? But there's also going to be a global economy slowdown because now this virus has impacted almost every country, right? The whole economy, the whole global economy is going to slow down. So my thinking is even on multifamily class B and C, where people are living paycheck to paycheck, they're going to go back to work and there might be a quick recovery. But people who are on class A, who are working from home, now their company is going to have impact, right? That's where the Dow is going to have impact because now your corporate profit is going to come down because now you have a global economy slowdown, right? So I think even though now this is just my thinking, maybe we can just you can figure out whether we're thinking the same. The class B and C is getting impacted right now. Class A not so much, but it's going to swap later on. Maybe in the second part of the W, right? Or the V in the second the W.
Well, it's starting already.
Okay.
If you look at office work and employment,
Mm-hmm.
and you read the news, you're going to see that companies that didn't lay off office workers are reducing their salaries.
Mm-hmm. Okay.
And you're hearing about owners saying, the owner of the company saying, okay, I'm going to waive my salary. Everybody in the organization is going to take a 10, 20, 30% pay cut with a floor, not to be no less than. Following that logic, you're taking all that money out of circulation and it's not being spent. So of course that's going to slow. Of course that slows things down. Mm-hmm. So the question is how long you definitely have a slowdown. That's inevitable. But the second piece is how long those people stay employed and are they able to get through this and operate at a level that with those cuts they can sustain operations and then start to pick back up when spending returns. It's going to be incrementally returning. It doesn't just, this won't be a light switch. So we're talking about W's, and then I talk about it's a dimmer switch, the dials. Okay. So you go and you can flip the switch in the room, the lights come on, but there's the round dial, you kind of push the knob and then you can adjust
Mm-hmm.
I think we're going to be doing that for a little while. We're turning the lights up, turning them back down, turning them back up. And it's going to be partially in response to people hearing about hotspots or breakouts of COVID until we have a situation where the majority of the population's been exposed and we've processed the virus, or we have a vaccine to manage the virus.
Yeah, but this is going beyond the virus, right? So, maybe the vaccine is already up in the next, 8 months or 1 year. I'm sure people are saying 1 to 1.5 years, but I'm sure the administration is going to cut a lot of red tape to, pull that in.
They built the nuclear bomb pretty fast, right? They had to.
Have to, yeah, because, during this crisis, everything is all hands on deck, right? So yeah. All processors get thrown away or, there need to be some kind of leadership happening there, but I think it's happening. But I just think the second order effect, right, on this overall slowdown, on the job losses, on how the world is going to change, right? And how it's going to impact commercial real estate. What do you think would be impacting in commercial real estate? Let's say, you have experience in office, multifamily, retail. So let's go through each asset class and see, what do you see as impact?
All right, retail, very significant damage to retail. Okay, department stores are pretty much talking about the end of their era here. This may be an extinction event for the department store.
So do you think even if today we have a vaccine, what would be the impact be if we already have a vaccine?
If we had a vaccine for the department stores?
Yeah, for the department store, for the retail industry.
I don't know that they really they survive longer, but this is devastating for them. When Walmart, Target, Costco, and Amazon are seeing 25 to 35% revenue growth, that's all that money is flowing in different directions than Macy's and Lord & Taylor and Nordstrom's. So the department stores are definitely They were weak coming into this. This is terrible for them. General retail, I think quick service restaurants like with drive-throughs come back very quickly. The drive-through is kind of an ideal service model for this environment we'll be going through and coming out of. And the cost point, it's a low cost dinner, dinner for the family to go to Chick-fil-A, and grab, feed the family for $50. So, quick service comes back quickly. I think some of the other sectors where we've got, experiences, it's interesting. Services and experiences were really kind of the bellwether in this e-com impact on retail real estate, but they're getting hammered. And so you're going to have some service and experience spaces return. They'll reemerge from this, and the weaker ones, they just won't make it back. They won't make it back. So I think in restaurants, full service restaurants, maybe half of them come back from this. It's just going to be very difficult to reopen all those.
But don't you think someone is definitely going to buy that space, somebody else, and have the same vision as the previous owner? I mean, maybe the original owner is no more there. 50% are gone, right? Because they can't last it. But someone is going to buy.
You're going to see new operators come in. Yeah, look, full service restaurants, they can be recycled, and you're going to have operators say, "Well, we made it through. Let's open another location because it's on sale. We can get the equipment and refurnish it and open and go." So there'll be opportunity there for new operators.
So the industry is not going away. It's just the operators are disappearing.
The operators will disappear. It's a slow recovery for them. It's a difficult recovery, and the real estate. There will be some good restaurant real estate that will become available. It will happen. Okay, so retail. That's sort of my take on it. I wish I could.
Are you seeing a lot of distressed sellers right now? I mean, you do a lot of transactions right now. People.
No, not right now. I think it's early. It's early.
Yeah, I think it's still early. I think people are just riding through their cash flow, just watching, and nobody knows what's the price, and not many people are distressed.
Yeah. Multifamily, I agree with you. If you segment by class, A, B, C, you look at the populations that are renting from those units. The A class seem to be more insulated because they tend to be professional, high income office working employees.
Still can work from home, I guess, right? So.
Yep. The B's and C's tend to be more service level, and they've got a lot more exposure in this environment. So, they get laid off quickly, but they get rehired first because they're lower cost. The office workers, they get hit later, and they're slower to come back. What's that rule of thumb? If you've got, for every $10,000 in salary, it takes you a month to find a new job.
Oh, I never heard that, but that's new. Ratio.
I don't know if it's true, but I've heard that. Bigger question that I've got on multifamily is the suburban versus urban. We've been in an urban cycle the last 10 years.
Yes.
And I've been...
Explain that a bit. What do you mean by urban cycle? Is it people building more multifamily in the urban areas?
Yeah, it's the live, work, play lifestyle, millennials and baby boomers wanting to live in the city. Near where they work, walkability.
Yeah, people like more
rich environments. That there was a quote that I was reading today from Goldman Sachs, and they're saying they're expecting a flight of millennials to the suburbs from urban markets, and it makes sense. What does a suburb offer? Less density, more value for what you rent. You may be working from home more, so they may be making decisions about, well, I could have done a 1-bed, but I have to get a 2-bed because I need a home office. That's a consideration to take into keep in mind. And then there's just the overall comfort of, hey, I don't want to be in downtown New York right now. That's not a good place to be. I want to get out to the burbs and just have some more space. So I think the idea of urban versus suburban is it's going to be a big topic here over the next 4, 5, 6 years.
Got it. So I think that's very prevalent in where you are, but you also buy in Texas, right? I mean, from what I see in Texas, everything is a suburban mid-rise apartment, right? A garden style apartment. So I don't. Yeah. I mean, there's very, very people I know who buy apartments near downtown, even though they are. But
sure.
But it could be, depends on which market we're talking about.
Right? I agree with you on that. Northeast, we have a very clear urban suburban experience. Texas, it's you guys just keep building rings.
Yeah, we have a lot of land here, right? So
Plenty of
everything's
land,
garden style, and
plenty of
we
land.
live in a garden. Right?
Yeah, as long as you got the water.
Yeah. But there could be like tertiary market where it could be more interesting. I'm not sure if people with less density or not. I mean, everything seems to be less density for me in Texas, just because we have a lot of land here, and people move around pretty well everywhere, I guess. So
yeah, you got a lot of roadway.
Yeah, could that also mean that there's a lot more investment coming from the coastal city to places like Texas or Florida, where
it could mean that. Yeah, the suburbs. What's interesting about the last cycle nationally, the suburbs have been kind of out of fashion. So it didn't have the same run up in value that the urban markets did. So I started to see that the last couple of years, where investors were starting to look at suburban markets and say, well, I can still get some yield there, so I'm going to go invest in the suburbs.
Mm-hmm.
This is now going to really bring that conversation to the forefront.
Yeah. I think that's where like places where you are, like Boston is called like gateway cities, right?
Mm-hmm.
Versus places like where I am is not really gateway.
Yeah.
It's like a suburban market, I would say, right? So
yeah. So industrial, I'm still bullish on industrial. I think we'll see some dislocation in distribution and port industrial. I don't know what the future looks like with China. I mean, we import a lot from China through Long Beach and the inland, and it goes to the Inland Empire. And I think we're going to see some of that shift to other port markets as we start importing from other parts of the world. But overall, with consumer behavior shifting, it had already started before this. If there's been anything that's going to accelerate the demand for industrial space, it's this, because you're going to have ghost kitchens, restaurants that basically they're like catering kitchens that they just run full time. They have no seating and they deliver food, meal prep. You're going to have more demand for online consumption and distribution and shopping. That's going to put more pressure on existing industrial inventory. I sort of thought the industrial market was peaking in the last couple of years, but that may not be the case. There may still be some runway in that market.
So when you talk about industrials, basically warehouses where products are made and distributed, I would say, right? So I mean, I can see that with more manufacturing going to be coming in house right now, right? I mean, with all this, that's one shift that's going to be permanent.
Yeah,
everybody knows that, right? So do you think industrial would be the asset class that most beneficial from that? I mean, because I'm looking at, there's going to be a lot more manufacturing factories coming here. I just don't know which asset.
Yeah, and that's really, I mean, you remember doing 102 in CCIM, and we talked about basic employment.
Yes, absolutely.
And as soon as you start to see manufacturing coming back in the United States, that's going to be a really, really good thing for our economy.
Correct.
It's going to really boost multifamily a lot, and it will help retail and it'll help office. But it's really a value. It's a power source. It's an economic engine for importing money into local economies. I think industrial overall, in terms of, if you're on the buy side, it's like you want to be really careful about industrial exposure to China, but the rest of the industrial story, I think, is it's going to be a good place to be. I think it's going to be a good asset to own.
So is industrial equivalent to manufacturing factories?
Yeah. So manufacturing, flex R&D, so that's research and development, warehousing, distribution, bulk storage, cold food storage. You're going to see that stuff cranking.
Cold food storage.
Okay, yeah, cold food storage.
So this is not the self-storage that we're talking about.
No, we're talking about like freezer facilities, that type of thing. Yeah.
Why is that?
It's because people are going to be continuing to demand home delivery of food, and you got to store it somewhere.
Well, I never seen one whenever I drive around, so I don't know where is it being stored.
They're kind of funny looking, if you sometimes on the outside they're a little funny looking. But
Now it's going to be look nicer because it makes more money, I guess.
Yeah.
So how do I position myself or anybody else listening? Let's say if I want to take advantage of this manufacturing coming in house, right? I mean, how would a commercial real estate investor should be able to position?
That's a good question. So you want to, the main thing about manufacturing is you want to find buildings that have good characteristics for an efficient manufacturing operation.
Mm-hmm.
So grade level, slab on grade buildings with ceiling heights in them that are, preferably 16, 18 feet or higher, that have good loading access. So you can get a tractor trailer or multiple tractor trailers in and around the building to access it. Plentiful parking for labor. So typically you're going to see, one parking space per 800 square feet is the code, kind of the building code standard for manufacturing warehouse. But depending, power supply, do you have enough power coming into the property, and utility services. So you're probably going to be able to find some outlier properties that you can bring into that market, convert over. And I mean, the other thing is you might want to be looking at retail and converting that to distribution. That's zoning is restrictive for that. Mm-hmm. Because typically municipalities don't like to see industrial uses in retail locations. But you may end up seeing big box or department store or retail buildings that have those characteristics of what I just described, because a lot of them do, being converted to that use. It could be manufacturing or it could even be distribution.
So which market should we be looking at to position ourselves for this kind of industrial asset class?
I think, frankly, I think you can look at pretty much any market in the U.S. I think this is not a specific market. Now, I think you can do this. You can follow that formula in any market in the U.S. Now, if you want to do let's look at the demographics and the economic drivers in a market. You want to look for population growth, employment growth. If there are more people moving there and living there and it's growing, that's a good thing because people demand space.
Yeah. Well, I mean, the other way to look at it also is like if there's already a manufacturing hub in that city or state, that could be a good expansion place, right? If you find some assets around it, I guess.
It could be. The other thing you're going to see are companies trying to find manufacturing redundancy. So if they've got a facility that goes down in another location, they can continue supplying from an alternate. Which is, it's interesting because it's sort of contrary to what Gordon Gekko would tell us to do, right? Build shareholder value, become more efficient, mm-hmm. and be more profitable, and do things faster and increase volume. And the way you do that is you bring everything into one location and make it as streamlined as possible. But now we're looking at a situation where, and this has been going on in manufacturing for a little while, customers demand redundancy because if there's an event or a disruption to a location, they want to make sure that they still have a continuity of supply chain. And so they're getting what they need. So that's even more important now than it ever was. So we'll see some of that. So I think you gotta kind of get into that world and talk to people and find out who's looking at bringing things home, who isn't, and then start to think about the properties that they could be using. And you might even have the opportunity to go out and pick up some land and put something on the land for someone.
Yeah. And I'm sure there's going to be some kind of government incentive to do that, right? Because now the government wants a lot more manufacturing.
I think so. Yeah. So office.
Yeah, let's go to office.
You working from home?
Yeah, I am.
So what's going to happen?
We'll continue to work from home, I guess.
Yeah, I mean, so if you had a choice today to go to the office or work from home, which would you prefer? Is the question. And I got to imagine a lot of people are saying, "I'd love to get back to the office. I miss talking to people, socializing." That's missed. And I think the home officing thing is great, but boy, when it's home officing and schools are shut down, it's really hard.
That's a good point.
So this sort of experiment is, forced home officing. Can companies do it? It's, we've got a variable that shouldn't be there, and that is the kids. The kids should be at school. I think people go back to the offices, but offices may end up seeing a similar thought, which is, hey, instead of piling everybody onto the train or getting everybody into the center of the city to work, maybe we need to have a smaller office in the center of the city and then have some suburban offices, spread people out, improve their commutability, and create redundancy in our workforce, with people being closer to their smaller offices. I think that I'm hearing that a little bit in the market now with people I talk to. I think that's something to keep an eye on. That, again, I kind of like the suburbs. I think there's an opportunity in the suburbs, and office may actually be a suburban opportunity here.
Got it.
Yeah.
So what you're saying is people are just going to go back to office. I mean, it's not going to die, but it's going to be a lot more focus on suburban, right? So,
I mean, if anything, we've gone from in the office space. I mean, you see these offices where people are like, they're benching. I went into an office building and people were waiting in line to get in the bathroom in an office building. And the reason is that the building was built for more or less one employee for every 300 square feet. And when companies come in and they go, we're going to be more efficient, we're going to get one employee in for 135 square feet. All of a sudden, the bathrooms are overloaded, the parking's overloaded, and the buildings, it's too dense. The amount of people in there is not designed to carry that density. Well, throw a pandemic in the mix, and the idea is for us to be 6 feet together in this world we're in right now. Maybe we're going to see that, that office demand change where, I want to be able to shut my door to an office. I don't want to be at an open bench next to my colleague sneezing on my keyboard, So that I think we go back to the office. It's important. The nature of the office is to bring us together and for us to work and collaborate, share ideas, but also to have deep work time. We need to be able to do deep work, and we need to go somewhere to do that. So maybe it's not about packing as many people in and forcing them to, assemble and work together, rather spreading them back out a bit, providing some work from home, some work from the office days. Maybe you're home 2 days, 3 days in the office. So this is a fluid one, but I think we're back. We go back to offices. I think it's how we do work. I mean, we can do it this way. We can talk to each other, but it's not as fast, in my opinion. Information's slower than it is in person.
Oh, yeah, absolutely. Absolutely. Yeah, I was talking to Dr. Glenn Mueller, right? So I'm sure you know him, right? This was like 2 months ago when we're looking at all the asset class, and office was the opportunity because it was going from, it was just recovering, going into the expansion cycle, right? So, and I asked him the same question, hey, what about people working from home? He said, well, human are social creatures, they like to be together, right? And you are absolutely right about communication and deep work and all that. Just so hard to do working from home. I think people are going to go back to the office, especially after the vaccine is back, right?
Yeah, I will make this prediction. So just like after 9/11, the U.S. government moved in security and defense. This is a healthcare crisis. I think the next decade will be a healthcare decade. As people, we tend to overcompensate for a trauma that we just experienced so that we never have to feel it again. And so I think we're going to see, when we rebound from this, healthcare will come back very quickly because there will be such a backlog of demand for everybody else who's not suffering from COVID, but has a knee replacement or, an oncology treatment. I mean, everything. They're going to be, they need to get in for services. But we're going to have a situation where healthcare is going to be at the forefront of government decision-making, investment, and in development of protective and planned responses to anything like this coming again. So I see that space as a very fascinating space to watch and get involved in as you see us start to come out of this and these discussions come to the forefront.
So how should we prepare for that opportunity?
Well, it centers around the hospitals. And if you follow hospital strategy, they've been merging with each other to become more efficient as they struggle to operate profitably in a very narrow margin environment. And one of the things they've done is they've expanded by going out into retail-esque locations and creating outpatient and urgent care services that essentially become a feeder for the hospital. So I expect to see more of that because that's a lower cost way for hospitals to expand. Hospitals are very expensive and they tend to be constrained geographically because of where they were sited. You don't see a lot of just new hospitals being built around the country. They tend to have additions put on them. So as a result, they expand out into multiple locations that become more like a hub and spoke model. So I'd be looking at anything in the healthcare space in the next several years. I think it's just going to be a really, really good place to be.
So are you talking about like medical offices? Or are you talking about
Medical
labs?
office. Yeah.
Or life sciences, medical?
Medical. I can't really comment on life science. I don't follow it very closely. It's so specialized. But I probably should know more being out of Boston because it's a center for it. But
it's big center. Right?
I hear about it all the time. I just kind of go, oh yeah, labs. But no, anything with healthcare. I'm loving it in the next several years.
But even on medical offices, I mean, the tenants have long lease terms, right?
Yeah.
I mean, how would that increase the valuation of the property as a real estate investor? One is we look at cash flow. The other thing we want to look at, value increase as well.
Well, it's durability. Mm-hmm. That's one of the great things that medical office offers you is you got like a 90% and higher renewal probability rate. Historically, it's been a recession, quote unquote, proof investment class. Not this time. I was looking at data last week. 42,000 healthcare professionals lost their jobs.
Oh, really?
Were laid off. I mean, you go, what? No way.
Why is that?
Why is that? Because hospitals aren't allowing for elective procedures and it's urgent care only. So they're laying people off. It's a fiscal nightmare for the healthcare system right now. So that's short term. Okay. There was version 3 of the PPP we're on now. Mm-hmm. That just came out and there's billions of dollars going to the healthcare system, which is a good thing.
Got it.
That's a good thing. So the short-term healthcare is volatile. That may be the opportunity to pick up some property. I think that over the next decade, it's going to be a wealth builder.
So you mentioned about some of the healthcare, which is located in the retail centers and all that, become like a hub and spoke model. So that's like single tenant healthcare, right? Compared to multi-tenant.
It could be single tenant, could be multi-tenant. You might have a medical office building with four practices in it. Mm-hmm. Sure. Got it. Yeah, I think those are good, really good investments.
And it could be offices converted to medical offices as well, right?
Yeah, it could be. Yeah, I mean, I just look back at 2001. I mean, if you were in the the metal detector, security business in 2000, probably not really interesting.
Right. Yeah. By 2001, everything.
Yeah. So that's what I see here. I'm like, this is going to be interesting. There's going to be an overreaction in healthcare. I think there's going to be opportunity there.
Could there be like construction of healthcare facilities like medical offices, or do you think just buying new medical offices?
I think there could be development. We're early on that. I don't know that that's anything that we're going to see probably for 3 years. Mm-hmm. I'm just following the trend. I'm kind of following how people are, what they react to, and then where they go. And for us to come out of this and not have a national discussion about how are we going to be prepared for the next pandemic? It's going to happen, and money's going to flow there, and there's going to be a lot of pain, and people are going to say, I don't want to do that again.
Yeah.
I don't want to hear about ventilators next time, And so I think that presents an opportunity for investors to get in front of that now.
Yeah. I'm sure for the next 3-4 years, people are going to say, we do not want to have that healthcare problem again, right? And I don't mind paying for this, right? So kind of thing. There's going to be a lot more investment. So I think medical offices would be a really good investment move.
Yeah, I liked it before this, and I like it even more after.
Awesome. Good. So what about other asset classes like self-storage or mobile home parks and, what else is there? Warehouse, I think, is probably part of the industry.
Yeah, we talked about warehouse. Hey, self-storage, kind of a maturing asset class late in this last cycle, but I think it's still very, very viable, and it's a good place to be. You are gonna have dislocation of residences in the next couple of years, so self-storage is going to be valuable to people who need to store their belongings. Mobile home parks, I mean, look, everybody needs a place to live, and if it's affordable, it's gonna work. So I think I see an opportunity too.
Got it. I think multifamily, we did talk in detail about it, right? Do you think there's going to be a lot of crash happening in the single family space because there's so much of short-term rentals? People bought a lot of short-term rentals as second houses, and right now there's no short-term rentals happening.
Yeah, that's not so good. Kind of the Airbnb. I mean, you're sort of in the hospitality business there. So yeah, those folks are going to need to convert to long-term or sell.
Correct. So I think there's going to be, a lot of people, giving up their second short-term rental houses away to the banks, and there could be a lot more houses available, I guess, right? So
yeah, that could be an opportunity. If you want to buy and rent or buy and rehab and resell, that space could have some volume coming through. Yeah.
Interesting. Yeah. I mean, did I miss out any asset classes? I think that's the more important.
I think we got most of them.
Yeah. And do you think we are going to be much better in terms of economy wise, just because there's going to be a lot more base employment, which is manufacturing happening in the US? I mean,
I'd love to see that.
Yeah.
I'd love to see it. I hope that, I hope our companies can come home with that. Mm-hmm. And who knows? I mean, with the unemployment rate being what it's going to be for a while, and the wage growth that we didn't really see in the last 10 years, and we just lost on that, maybe there's an opportunity for us to employ people that, otherwise we couldn't have on a manufacturing basis to make it make sense. I don't know.
Yeah.
I'll leave that up to the manufacturers to figure out.
Got it. So I don't want to forget one asset class, which is hotels, right? I'm not sure whether we went deep into hotels. So that's going to be, I think hotels are really suffering right now.
Oh, it's terrible.
Right.
When I hear 9% occupancy rates.
Yeah.
That's bad news.
Yeah, that's crazy right now. So hopefully hotels survive through this downturn, I guess, right? So
some will. They'll look. We still need hotels.
Yeah, I know.
We still need them. So they're the strongest, best located hotels will come out of this thing. Others, they won't. They'll fail, and they'll either get bought at a discount and with a lower basis, they can compete in the market and grow back out, or you're going to see them reused for something else.
Got it.
Maybe that's the multifamily conversion.
Yeah, if the city allows it, of course, then it could be a lot of studios and efficiencies, I guess. Yeah. Right. And I've seen that happening in some cities and some projects. So.
Mm-hmm.
All right, Jeremy, thanks for all the value. Can you tell our audience and listeners how to get hold of you?
Sure. So you can check out our stuff on creinvested.com. That's creinvested.com. I've got an investment course there that is available. And if you ever want to chat with me, you can email me at Jeremy, that's Jeremy, at creinvested.com.
Yeah, Jeremy is a wealth of knowledge. I mean, he's also a senior CCIM instructor, right? So there's a lot of knowledge with him, and absolutely, would be a really huge value to connect with you and just to learn from you. So thank you very much for coming on the show.
Hey, thanks, James. It's a pleasure.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.